Good afternoon. Now it's on. My name's Nicola Hahn, and obviously you guys are all sitting here wanting to know what the apartment market's doing here in San Diego. We have a great market, but we have Josh Old, the Director of Market Analytics for San Diego from the CoStar Group here. Josh's focus centers on the CoStar Market Analytics platform for the San Diego multifamily and commercial markets. In his role, he has authored more than 100 reports, providing detailed analysis, and frequently presents his findings to trade groups, like our association here. His work has been featured in the San Diego Business Journal, the San Diego Union Tribune, the Daily Transcript, the Voice of San Diego, and many other local media outlets. Please welcome Josh as he presents the overview of the San Diego apartment market and how demand is holding up as we head into the future. Josh.
All right, thanks a lot, Nicole. I appreciate it. Thanks everybody for sitting down and joining us for a little bit today. I'm Josh Ohl. I'm the Director of Market Analytics at CoStar. You'll have to forgive me. I'm not used to standing in front of people. It's been a long, long time since I've done one of these in person, so you'll forgive me a little bit, but also you'll notice I don't really even look like my picture anymore. It's been that kind of pandemic, hasn't it? Anyway, just to give you an idea of what we're going to talk about today, here's our agenda. We're going to talk about the fundamentals of San Diego, sort of the backdrop of what's happening in the local economy. And we'll just drop through all the sort of different sectors of the apartment market, looking at the demand profile, rents, supply, and then we'll wrap up and let everybody know what sort of is happening on the sales side of the market. We're obviously, I think it goes without saying, we are sort of almost in unparalleled times now with what we're experiencing on the apartment market. I think we're all seeing things out there that we're not accustomed to seeing, or things that we haven't really seen in 20 years in the market, right? Demand is skyrocketing, rent growth is soaring. Construction is what it is in San Diego. There's not much of it, regardless of what Sacramento does or the city council does. We just don't build a lot, and we'll see if that's going to change anytime in the near term. With that being said, let's jump into the thick of our discussion here. So here we're just going to look at what's happening in the local job market. This is just month-over-month employment gains. I apologize for the scale of this, but we never lost 225,000 jobs in a single month like we did last April, which is why it's so stretched out and why it's also so small at the end. That being said, we have started regaining jobs in 2021 here, but you can see it's been uneven. We gain a couple one month, we lose a couple another month. This past month, we lost about 7,800 jobs, which is sort of wiped out the job gains from the previous 2 months. So it's sort of been that type of recovery. Now, if we were looked at the job market on a year-over-year basis and job gains, things would look like they're humming along. We would have added over 60,000 jobs, 5% employment growth. The market would be on fire, right? But it's probably better to take more of a look at what's happened in the market based on February of 2020 as our baseline to give you an idea of what's happening now versus the pandemic arriving in San Diego and just sort of wreaking havoc across our economic landscape, if you will. We're down about 7.5% employment compared to February 2020. No sector has been harder hit than the leisure and hospitality industry. That being said, every single sector, with the exception of construction, has experienced a job loss since last February. Construction, I'm not alone. You drive through neighborhoods, there's a reason construction is up, and it's not just because we're building commercial, not really building more on the apartment side, but drive through residential neighborhoods. You have contractors redeveloping houses, renovating homes, building ADUs. That's sort of the nature of where we are in the market right now, and that's what's sort of happening. And that's why that's why the construction sector is doing well in the market right now. The good thing for San Diego is population growth is beginning to return to the market. Our population in San Diego is large. Our growth is largely driven by natural growth, right? Births over deaths. We're having more children than we are people dying. That being said, the percentage of births in San Diego last year fell for the first time in about a decade. That's something to keep an eye on, particularly as we want more people in the market. That's good for the market. Those driving population growth, that's driving housing growth, that drives job growth. We also had an uptick in deaths last year. It's hard to say if that's attributed to COVID just because the census data was through July last year. So it's not necessarily a COVID-related increase in deaths. That's just the nature of where we were. When we look at migratory trends in San Diego, it's generally been driven by international migration, which has generally propped it up, whereas domestic migration has tended to be a net negative impact on the market as a whole. That changed last year for obvious reasons too, because we shut down our borders largely to migration and international travel. Probably going to have to take another year or so for things to shake out and get back to an even semblance of where we are as far as population growth is concerned. The good news for San Diego too, though, is when you look at where population is growing strongest among Southern California counties, San Diego is doing relatively well relative to Los Angeles and San Bernardino and Orange County. I mean, if you're going to choose a Southern California county, San Diego is pretty good, right? We have sort of everything that you'd want. 70 miles of beaches, one of the most booming life science markets in the country, which is probably one of the things that's propping up our market and sort of leads to this tilted balance of the cost of living rising so quickly as it is because the jobs that we're adding to the market right now are just jobs at the top of the market. Those biotech jobs that are growing in North County and Central County, average incomes are about $130,000 a year. So that's one of the things that's driving population growth. And I think we're also, because of the remote working requirements that are now sort of endemic across particularly the tech industry as a whole, San Diego is becoming a great landing spot if you are a tech worker and can work remotely up in the Bay Area, LA, up in the Pacific Northwest. And you look at San Diego and its beaches and its sunny weather, what better place to go when you have cheaper rents down here than those areas? We're finding a lot of those people can come down here and take advantage of our affordability and our great weather and our great job market, if you will. This is just to give you an idea, according to the latest census data, looking at sort of income buckets as far as what sort of renters are falling into as far as what income is they're pulling in. The good news is, the top half, the people making over $50,000 in renter household incomes, that's remained steady, if not increasing. We could probably expect those bottom buckets to begin falling. I would imagine too, once the eviction moratorium falls off, we're going to have a lot of renters that are going to struggle to maintain their footprint in San Diego, especially when they're coming out of rentals where their apartment rents now, when they're trying to find a new rental, are maybe 15, 20, 25% higher than when they jumped into them perhaps a year and a half ago. So that's something to keep in mind. Again, that top bucket too, as we look at the market as a whole, a lot of that top bucket, you're getting people that are homeowners that are going into rentals. We also have a lot of renters by choice, right? Those that don't necessarily need to rent, but they're choosing to rent right now. But that's also a consequence of this. Our home prices right now are skyrocketing. This is the Case-Shiller Home Price Index for San Diego, and this is indexed to 100. I apologize ahead of time. I like indexes. So we'll see a lot of slides here that show indexes, and it's just an easy way of tracking where things are now so you can get an idea of where a baseline was at some point in the past. And this is just indexing it to the beginning of 2019 so you can get an idea of the changing home price value in San Diego. But this is one of the many reasons that we have such high demand for apartment rentals right now. The pricing for homes has skyrocketed since 2019. It's really been much more of a gradual increase prior to that, but since then we have, if you look at a year over year, I think we're only second behind Phoenix as far as home prices rising in San Diego faster than any other metropolitan area in San Diego. And that locks people into apartments because, number one, home prices are skyrocketing. It's a little bit more difficult maybe to gather a home down payment, but it's also the housing inventory right now is remarkably low. A healthy market is generally about 6 months of for sale housing inventory on the market. Right now it's closer to about 2.5 months. Homes on average are generally entering escrow and closing in about 40 to 42 days right now, which is just insanely fast right now. You think about it, homes go on the market on a Friday. They want their highest and best offers on Mondays or Tuesdays, and that's the nature of the market. Right now, as a home buyer, you think about it. You're touring a house for 20 or 30 minutes, and you are oftentimes making a $1 million decision in 20 or 30 minutes. What other point in our lives are we making such a monumental investment decision in such a little amount of time that we are? And that's just the state of the housing market on the for sale side. It's hard to say where this is going to end. I know its mortgage rates are remarkably low right now, and it's a hot buyer's market. Mortgage rates probably ticking up a little bit. It's still going to be a good market. We have more people wanting to buy homes in San Diego than are selling homes. And you have to think about it from a seller's perspective, particularly those sellers that want to jump into their next home. How much sort of confidence do you have to sell your home and find that next home that you can land in, right? I think the average, generally speaking, is first-time home buyers, they stay in their home for about 9 years on average before they jump into their forever home for the next 20 years, before they maybe jump into a rental or a condo or do something like that. Right now, we're starting to see that time stretch out just because that lack of confidence from a home seller to find that next home. And again, that harkens back to when we look at job growth on the construction side and why it's booming right now is because renovations are everywhere. Because if you don't have confidence to buy the next home, what's the next thing you're going to do? Maybe I'm going to add a bedroom. Maybe I'm going to remodel my kitchen. Maybe I'm going to add an ADU, which is sort of where the market finds itself right now. All those factors are sort of coalescing into our demand profile in San Diego, right? We just have we have lack of for sale inventory. Remote work makes us a very attractive market for people in very costly markets to move to San Diego. We have an eviction moratorium, which is keeping apartments filled. All of those things are sort of coalescing to sort of support where we are in demand right now. Sort of We're going to look at a number of charts that look at demand and availability rates. We're lucky at CoStar and Apartments.com is that we have 40 to 45,000 observations that we get on availabilities in the market and rental rates in San Diego, which helps us get really great insight into what's happening in the market on a day-to-day basis, right? You can see the blue line is looking at the CBD or downtown San Diego. It took a while, right? The pandemic hit San Diego. Everybody's a little bit hesitant. What are we going to do? I'm working from home. Do I want to be downtown? It's a little dense. Everything's closed. I can't go to Padres games. I can't do what I've typically done. So we can see the availability rate hanging around a little bit higher there. And you can see what it's done in the suburbs though, right? Get out some green space, get out to bigger apartments, get out to more open areas in San Diego. Well, that's sort of changed a little bit here in 2021. And you can see downtown, you can see the CBD, you can see the suburban area. Everything is sort of just collapsed, if you will. We have an availability rate largely across the entire market at about 1%. Now, if you even look more at sort of the broader, pull back a little bit on the entire San Diego region and let's look at the 10 largest landlords in San Diego that have a market share of about 55,000 apartment units. It's about 17 to 18% of the total market share of market rate apartments. Their occupancy rate right now is 98.7% across the entire market. 98.7%, that's remarkably high. And that's one of the reasons that availability rates are so low right now. This chart right here, this is a bread and butter chart of the CoStar Group. When we look at our data, we like looking at things, supply, demand, and vacancy, and see how all of those interplay with one another so we can sort of get an idea of how those interact and what's happening. So we're looking at the orange bar to sort of give you an idea is just our demand profile on a quarterly basis, sort of what's being absorbed in the market. The blue bars are basically just looking at supply, what's being added versus what's removed from the market. And quite frankly, there's not a lot of supply that's being removed from the market. And the horizontal green bar, that's just our vacancy rate. That's our overall vacancy rate. You can see the vacancy rate is starting to nosedive. We're below 3% right now. And you can see where we are on the demand profile. We have now hit 4 straight quarters of demand over 2,000 units per month. We're right now we just passed a quarter where we had about 3,500 units of demand. Right now in the third quarter, we're at about 2,000 units of demand quarter to date. Again, you can see we just haven't experienced demand like this. You go back like 20 years, we haven't seen quarterly demand quite this strong. And you can say, that harken back to, I don't know if there's any baseball fans, but they just played the Field of Dreams game last month between the White Sox and the Yankees. I'm a Yankees fan. I was disappointed at the result of the game. But anyway, I apologize for that tangent. If you build it, they will come in San Diego, which is the idea that we are outpacing demand. We are largely outpacing supply with demand. If you build it in San Diego, renters will come to that apartment and will rent, and that's what we're seeing right now with new supply. So we looked at more of the green bar in the last chart was charting just overall vacancy rate. That sort of includes the messiness of new supply. You add 500 apartments downtown, that gets added to our demand or gets added to our vacancy profile. The blue bar here is more of a stabilized vacancy rate, which gets rid of brand new deliveries so we can sort of have a same store idea of what's happening in the market. So we're looking at properties that delivered 18 months ago or longer, or buildings that have newly delivered but have reached 90% occupancy, which we consider, at least in our side as far as a property having stabilized. We are now at about 1.6% overall vacancy rate. So that's not availability, that's just a vacancy rate. So that's just drum tight. It's going to be hard to go below that. I'm sure we will tick down a little bit in the near term, but there's not really much further you can go, if you will, right? When we look at demand and we look at thousands of units being absorbed across the market, there's not much more that you can go. And it's the same on the for sale market. How many renters are eagerly looking for new apartments? There's just not that many apartments to look at right now. You look at search engine traffic on Apartments.com, it's never been higher. There is just more people looking for apartments right now than ever before, but there's just fewer avenues for people to move into. So when we look at across the market, we obviously have the whole regional aspect of looking at San Diego County, but we can also look at it more on a sub-market basis, looking at it more of smaller sort of micro markets across the county, if you will, from the Balboa Park neighborhoods to downtown to East County and North County and the 15 corridors. Basically what we're looking at here is the green diamond there is just our vacancy rate in each of these areas. And then the blue looking at the 12-month absorption or demand versus the orange, which is 5-year average, just so you can get a sense and visualize the strength of demand across all of the market, not only across the county, but more of localized demand. And you can see demand largely across the entire county. It doesn't matter where you are. It's largely doubling, tripling the long-term average for demand in most of these places. Half of our submarkets that we track in San Diego have a vacancy rate below 2% right now. We have a couple that are even below 1%. I don't even know that. That's just remarkably low, right? Even downtown San Diego has fallen below 7% overall vacancy rate. Downtown's vacancy rate hasn't been in single digits for about 4.5 years, and that's largely before the wave of inventory started delivering downtown. And that's our vacancy rate down. And you look at our stabilized rate down there, it's even lower, right around 4% in downtown, which was remarkably strong. And it just speaks to, it doesn't matter where you are, that sort of notion of people being afraid of dense urban environment living, that's gone out the window. People want downtown apartments, and they're going to do it. And imagine what downtown's going to be like when IQHQ builds its life science campus down there. Excuse me. The campus at Horton delivers, they get an anchor tenant that's a tech tenant, what that's going to do down to downtown right there. We have the Mid-Coast Trolley Extension that's going to be delivered and be rideable in November. If you're a resident of downtown, you live up or you work up in the UTC area, you can hop up on that. You don't have to get out of your seat. You can get off at Genesee, you can get off at, in Torrey Pines, you can get off in the UC San Diego area or UTC, where you're going to have about 5 million square feet of office and lab space to be able to walk to from a trolley stop within about 10 minutes. So we also might anticipate that's just going to, I guess, entrench demand in some of those areas, particularly if you're a renter and you figure, you know what, I can get to work now. I don't have to worry about a car. It's going to make it a little bit easier to afford these apartments throughout the market if you don't have to worry about a car payment to be able to get to your work. Now that we're done with the demand profile, we're going to jump into supply a little bit right here. This is just looking at apartments under construction that we're tracking. This is market rate apartments, so we're not tracking affordable apartments, but just more market rate. And this is just over time where we are on a quarter-over-quarter basis. You can see we don't really build very much, right? You go up to an area like Portland, which is a small market. They've reached like 13,000 apartment units under construction at downtown. You go to Nashville, which is a smaller market. We're downtown, and some of those areas are building 7,000, 8,000 apartment units at once in some individual submarkets. Here, we're at about 7,200 units right now that are actively under construction across the market. Again, we probably should be adding about twice that we should be delivering on a year-over-year basis as far as all forms of housing. This year, we're probably on pace to add about 5,000 apartment units. Last year, we added about 2,300. We probably should be adding somewhere on average every year about 7,000 to keep up with population growth and demand, and we're just not getting there. This gives you an idea of where they're building. Sorry, I just threw this in. I like heat maps. We have this in CoStar. I thought it was just a cool visualization before we move on to the next slide. But this just gives you an idea on a heat map side, sort of where they're building. It's not really a surprise. We pulled in a hotel circle right here. We can see them building right out front here. They're building downtown. They're building along the 15 corridor. They build up in North County. Areas that are in high demand, areas with good job markets. They're building a lot in Chula Vista too, more wide open area, taking advantage of suburban living. We might see South County too begin to sort of build out its commercial infrastructure in terms of its office market. Right now it's more service related industries down there. We have some sort of good commercial projects that could be in the works that could really ramp up apartment demand even more than it is right now, and sort of become a really strong employment hub down there for South County if some of these projects get off the ground, particularly, like the Think campus that's being proposed, and they expect to start shoveling dirt on that pretty soon. This sort of gives you an idea of the amount of apartments they're building in each of these areas. So sort of we saw the heat map, and this is what's being built downtown, the F-15 corridor, Mission Valley, Balboa Park neighborhoods. Excuse me. And this just sort of gives you, again, it's not a lot of areas. You know, we could probably be building more everywhere across the county. There would likely be demand on it. Maybe for some of the interior county, it'd be a little bit more difficult. Part of the difficulty I'm building, though, obviously, is the entitlement process. You're a builder, you're building soft costs and count. It's just the permitting, entitlement, all that stuff. That's like 40% of your construction cost right there. Again, that makes it difficult. You want to start building somewhere, it's going to cast a shadow on a neighbor, on Balboa Park. All of a sudden, you're going to have opposition. That's the nature of building right now. You know, you have the NIMBYs, I know you have the YIMBYs. I think my favorite term is the bananas, build absolutely nothing anywhere near anything, which is we sort of similarly have a lot in San Diego. Give you an idea of where some of this is just sort of, these are sized based on the number of units that are being built or have delivered in some of these new projects. I apologize, it's a little harder to see from the back. Some of the new projects, Society right out here that's being built, more units are going to be on the way in the coming quarters. Gravity, where they built out in, out in Grantville, they're averaging $2,900 a month out there. Diega downtown, $3,400 a month. The Alexian Gallery right out down the road, $2,800 a month. Seton Apartments to me is one of the more interesting ones. That one delivered earlier. That's along the Marina Corridor. That's a short walk from the new Tecolotti transit station. That's right there on right off the 8. They're averaging $3,200 a month right there. Demand is remarkably strong for those. They're upwards of, I'm trying to think, they're averaging over 20 units a month in absorption. They're doing really well. Some of these apartments, like Courtyards Pacific Village, they're already 100% leased. They delivered earlier this year. They're not occupied all the way, but they're 100% leased, which speaks to the demand of some of these stronger, particularly in the Central County, North County nodes right there. But the reason I wanted to highlight Seton, that's one of those projects, particularly along that Marina corridor where they're building the trolley stations. That's where they envision where you can build denser multifamily communities along that area. Take advantage of the lack of parking requirements if you're within that sort of high transit priority area. The Seton Apartments, that's a short walk, like I said, to the Tecolotti station that's being built right there. The one bedrooms, I think, average about $2,900, $3,000 a month there. Demand is out, you know, through the roof for that apartment. But again, if you're a developer, you don't really need to worry about passing, you know, the idea was you can build denser product, build more units, have more sort of relatively affordable units, but that's not really the case. If you're a developer, you can build and get these prices per unit. You're going to get these prices per unit, and people are still going to line up out the door to get those units. So we looked at what's being built, and this is more just what's being started to give you an idea sort of what's going to come down the road in 2 years from now when it starts delivering. And you can see right here that what's happening to development, right? It speaks to the difficulty of getting projects off of the ground, that we just have hardly had any stops. Part of this too is we saw earlier when we talked about construction, the construction sector doing well relative to all the other employment sectors. That sector is still only up about 3,000 jobs since February of 2020. That being said, finding qualified construction workers in San Diego is one of the things that's sort of holding back, sort of ramping up development activity. We rely on a lot of construction workers coming across the border, a little bit more difficult coming across there. We're going to see what's going to happen now that employment benefits, the extra unemployment benefits just sunset, I think about 10 days ago, based on that, the passage of that law earlier this year. We'll see if that brings more people back into the labor force and maybe start to, you know, increase some of these, some of the labor market and bring back not only in the construction side, but it's everything, the service industry, leisure and hospitality. I'm sure I'm not alone in this room that had to wait maybe a little bit longer to get a table in a restaurant, maybe see like 2 or 3 waiters and waitresses handling about 15 or 20 tables at a bar or restaurant. You go to SeaWorld, maybe all the rides aren't quite open right now. Again, that's sort of the difficulty in the market and sort of how it translates into our economic and labor market. With that, let's get into one of the more interesting parts of the market. We looked at demand and supply, and now it's rents. Now, there's a lot of things out there with rents, right? We have a rent cap that was passed by the state that's at 5% plus inflation. This year, usually they look at the April number of inflation to get what that number is going to be. San Diego did not publish that for April, so we looked at March, which is 4.1%. Looks like our state rent cap is going to be about 9.1%. That being said, that's on essentially in-place rents renewals. A lot of what we're going to see here is just asking rents. Asking rents, you can raise rents, right? Again, there's the other caveat. We have the Penal Code 396, price gouging and rent gouging, right, as part of the state emergency law that was put in place by Governor Newsom last year, got extended this year. So that's one of the things to take into account about raising rents above 10%. That being said, some communities are definitely abiding by that. Many are not. We get rent observations where some communities you'll see rents going up $3,000 last year to $4,000 a month this year. Part of the difficulty in that aspect of that law is tracking what in-place rents were at some point from a renter before you went into that apartment. Gauging a 10% rent change on an apartment unit that's turning over, how do you really judge that if you're just someone that's looking for an apartment? That's one of the difficulties by the law. So we're going to look at a lot of rent numbers. That's my way of saying we see a lot of rent growth right now. There's a lot of rent growth across the entire county. And those are some of the factors that are playing into the sort of the rent picture that we're looking at. This is just looking at rent growth. We look at the orange bar as just our average asking rents in San Diego across the entire county. The orange bars or a year-over-year rent growth on a quarterly basis. So we ended the second quarter of 2021 at about 8.9% year-over-year rent growth. Right now, we're at about 12.3%. We expect that number to continue rising. Again, these are not renewals, these are asking rent growth, right? So you can see, we expect there to be some more runway on continued rent growth in the near term. I mentioned earlier, we are lucky. We get about 40 to 45,000 observations every single day for San Diego County. So we get great insight. Draw your attention back to about a year and a half ago. Look at like March, April 2020. That is because we can see the rents immediately fell for that month and a half right after the pandemic and the lockdown. We can see that because we get the daily rents on a daily basis. It's different than sort of that linear quarter over quarter line where it would have been more of a straight line. But you can see rent growth is just taking off where rents are moving on a day-over-day basis in San Diego. This is just one-bedroom rent trends. This is in San Diego on a one-bedroom average rents versus the national benchmark. And you can see we're outpacing the nation pretty comfortably by about 4.5%, 5% right now on a year-over-year basis. Things are slowing down. Not all markets across the county or across the country are doing as well as San Diego. Again, we're not the only market in Southern California that's doing great. Inland Empire is in the high double digits for rent growth. Orange County is in the high double digits, upwards of 20% year-over-year rent growth. But you can see San Diego is definitely holding its own, and we're really, if you're in a landlord right now, you sort of have really strong pricing power for your available units. This is looking at it more on a location basis in San Diego for the average one bedroom in the green, but then where it is in the suburbs versus where it is in downtown. And you can see the downtown area was a laggard last year. It took a while for it to really ramp up in the downtown area, and we can still see it downtown really shooting up. The suburbs are doing particularly well still, but downtown is doing really well. The year over year, well, we'll get to that in a bit on what downtown's doing, right? And this looks at it again. A lot of these are just looking at it, indexing to last year and where we are in bedrooms. I don't think it's too surprising on the studio side to sort of see studios lag the rest of the market. Particularly when you look at apartments.com search engine traffic, you could see it immediately. When the pandemic hit last year, the amount of people searching for studio apartments dropped immediately. It dropped by about 4 percentage points, and that's enough to make an impact on the market. Granted, a lot of those studios are being built in downtown where a lot of that was affected, but we're still down about 1% on regular search engine traffic for studios now than where we were pre-pandemic. 2 bedrooms, it's unsurprising. 2 bedrooms have been sort of the belle of the ball, if you will, right? It makes sense. You want a little bit more room to spread out. Maybe you need a dedicated workspace. 2 bedrooms work out great for those. Even 1 bedrooms are doing really well. And that makes sense, right? If you're in a studio and you're working it from home, after a little bit of while, the walls might start to close in on you. You might need a 1 bedroom after that, which is why we're seeing such strong rent growth trends in those sectors. I think this is the last index. Sorry for making everybody suffer through these. Again, I said I love doing these because it's just such an easy way to see where we were to where we are, and sort of everything is on equal footing to see where everything has moved. Each of these bars, blue is 2020 rent growth, green is 2019, and red is 2021. Typically what we see in a year in San Diego, the first 6 months of the year, we get about 3.5% rent growth on average. That's typical. Last year's the outlier, right? Because of the drop, everything was largely flatlined. We ended the year at about 1.5% rent growth overall year over year for the calendar year. But you can see what 2021 has done. There's just a sort of speaking to the pricing power and sort of the unprecedented nature of that pricing power in San Diego, where it's gone up 11% just year to date. I took this number, I think last week. That's when I had to run the slide, so I couldn't do it as of like earlier this week. But that was as of last week to give you an idea of where rents have grown. And still, we usually have that slowdown as the end of the year comes. I don't know if that's going to happen this year or not, just because of the nature of where demand is right now. And this is just looking at it by rent by submarkets. You look at La Jolla UTC. The La Jolla UTC area and the North Shore cities up there, Del Mar Heights, Carmel Valley, those are among the few areas in San Diego where rents actually fell last year. Downtown rents were largely flat last year. And you can see where some of these downtowns rent growth right now is 10.4%. You could see UTC, what they're doing right now. Some of these communities in UTC have raised their rents, average rents last year going into the pandemic, about $3,900 a month. Some of those same communities are upwards of $5,000 a month, $5,200 a month, which speaks to where, especially now that people are going back to the office. When I went back to the office in June, the parking garage was about half filled. People still weren't going there, but if you're driving the freeway corridors, I'm sure we've all seen the traffic start to pick up. The parking garages are starting to get filled. Makes more people more comfortable moving back into these areas and makes it more, stronger demand and a little bit stronger rent growth for some of these areas. Look at sort of when we break down rents by sector, whether it's sort of that mid-tier Class B housing or whether it's more of that workforce housing or whether it's the high-end housing, it's all in the luxury sector and mid-tier. Those are the ones that are propelling rent growth across the market right now. If you're a brand new apartment right now, you're not restrained by any sort of rent caps or state of emergency price gouging laws. You can push your rents as much as you want on those new units if they haven't been occupied, which is why we're seeing the strongest rent in a lot of these. And really, we're just seeing strong demand in a lot of these apartments too, which is why we're just seeing such huge rent growth there. I think after all that, it's sort of unsurprising that we're just seeing concessions largely. Who needs concessions when you have demand? When you have a couple of availabilities and you have 30 applicants waiting to fill those availabilities, you don't really need concessions. And we're even seeing it on the for sale or on the brand new construction. Downtown, oftentimes where you see upwards of 8 weeks of free rent. That's slowly starting to pull back to 6 weeks, to 4 weeks, to 2 weeks. You want to get that 6 weeks of free rent, you're going to have to sign a lease for 18 months, 21 months. You want a couple weeks of free rent, you might have to now sign 15 months. It's no longer that sort of 12 months is going to lock you into pretty decent concessions. So concessions, right now we have a multifamily department that's just calling and canvassing the market on a month-over-month basis to give us an idea of what concessions are. And right now across the entire county, it's about 6% as a whole. And in downtown, it's less than 1 in 5 communities are now offering a concession. To the for sale side, big green book, this is just looking at quarterly investment volume. We saw a slowdown in investment volume, I think made sense. A lot of investors were sort of holding their powder last year. The big bar on the right there, the deal for the Prebis portfolio just closed about 2.5 weeks ago for $1.45 million for 5,700 units and 64 communities across the county. I think it's probably the biggest real estate deal that we've had in Orange or in San Diego in at least 20 years, probably going back further than that. Again, The investors that were holding their powder last year are re-engaging in the market right now. Again, the difficulty too is because there's a lot more buyers right now that are looking for properties than there are for sale properties on the market. Lenders are busy. It's just the nature of huge demand and what rents are doing. A lot of buyers want to get in. There's just not as many investment opportunities now as there might have been in the past. And you can see what pricing is. We look at all the sectors across San Diego as a whole. Year-over-year pricing growth is over 10% right now on the apartment side, which is just huge. You can see it's the most it's been since we've came out of the Great Recession over a decade ago. And you can see our average price per door now is approaching $400,000. Again, when we saw those the markets change where, 13, 14, 15 years ago, we had tons of investors wanting to do the condo conversions, get a condo map, convert to condos, sell them because you could get a pretty penny on those. Now when you can sell your apartments for $400,000 a door, go out to El Cajon, get $420 a door, go up to North County, get $450 a door, who needs a condo conversion to get these prices when you can get it for apartments? Even though we see cap rates on an average falling toward 4%, it's not really pulling back investors at all. Investors are still putting their money. This looks to be a pretty darn safe market to put your money in right now, whether it's the ocean sides of the world, the El Cajons, La Mesas, Chula Vistas, a lot of these areas in the market where the demand is just not going to go away is where a lot of investors are putting their money. Sort of to wrap everything up that we've talked about, demand has soared over the past year. Both suburban and downtown apartments are sort of at record high levels right now. Vacancy rates and availability rates are at 20-year lows. And I could say it's maybe even longer than that. We just didn't track the data that much before then. So I only can have 20 years or so to look at it as a basis of comparison. Construction activity is still lackluster. I know Sacramento is doing what they can. SB 9, I think, is the new one where they say that we'd get rid of essentially single-family zoning, and so you can break up single-family parcels and put duplexes. But again, we'll see how much that's going to be applied across the county. Rent growth has responded. It's high everywhere across the county. Nearly every submarket is at record high rent growth. And there are more buyers than sellers on the market. It's just worth paying attention to that eviction moratorium. I know landlords are paying attention to it in the back of their minds. Stop paying attention to it a little bit. That can has been kicked down the road now for over a year. I won't be surprised if it's kicked down the road again at the end of September, probably maybe till the end of the road or till the end of the year again. So we'll see if that's going to fall off or not. We'll see what that's going to do to the market. But if people are moving out of there, we'll see what it's going to do. We might see, I don't know. We'll see if it's going to impact rent growth. We'll see if it's going to impact vacancies. It could a little bit. But what we're going to find, though, is what I mentioned earlier. We're probably going to have a lot of people that are going to be evicted from apartments to some degree that are not going to be able to remain in San Diego, and what that's sort of going to do to the demand and demographic profile of San Diego and the employment base in San Diego when that happens. Like I said, if you're getting evicted from an apartment, rents are up 25% now compared to a year and a half ago. It's going to be awfully difficult to find an apartment that you can afford in the county. And that's all I had. So thank you. I appreciate everybody for joining us today. Are there any questions at all that I might be able to answer? Or yes?
Is there any delta factor out there, like water, electricity, natural disaster, how that what would slow it down or cause it to slow down?
So as far as like a Delta variant, it hasn't. I think what we've seen and what's happening now, it's not only probably a result of the Delta variant, but it's more of people are just more comfortable moving around, right? So I don't think that's going to hold back, at least that. What that would do maybe is more hold back the commercial side of the market a little bit, with a little bit more hesitation on office side in particular. I neglected to mention, too, one of the things that the coronavirus has done and what's happening too is when we talk about development and all of these factors are playing, it messes up our supply chain. So that's also impacting development. If you're building 400 units, trying to order 400 microwaves and stoves overseas when they can't even get shipping containers out of China and Asian countries, and then they're sitting off of Long Beach and LA for weeks on end, and then trying to find enough truckers that are going to move them down here and trying to have sort of any sort of timeline to be able to move goods from overseas to here is just another thing that's gumming up the works, and it's hard to find an idea when that is going to smooth out. Right now it looks like it's a couple weeks, couple months, but I mean, there's a reason that used car prices are up where they are. There's a reason that car companies are dropping production because they can't get the parts that they need to meet their, what they would otherwise build. So, yes. Absolutely. There's going to be plenty of demand behind it. It's probably going to take some time to see where those units are opening up. We're probably going to see more in the workforce housing where that's going to happen, maybe mid-tier. You're probably going to have less of the workers coming in here. They're going to want to be in the coast. They're going to want to be in Central County, North County, those areas, sort of that, that V area above the split, the 5 and 805 split. So that's the only thing. We might see a little bit more softening in some areas that are a little bit more removed from the strong sort of higher employment nodes along the coast and the Del Mars, Carmel Valleys, Rancho Bernardo's, UTC, those areas. People need a place to live, right? People are moving out there. It's sort of no different than it sort of parallels what's happening on the for sale side, right? You're seeing 1970s vintage condos in El Cajon. That's a bottom floor condo that's 2 bedrooms, 900 square feet. They're getting half a dozen, 10 bids on it, and it's selling for $50,000 over market price. Or it's hard to say what market price is these days, because if somebody's paying, that's what the market is, right? So that's why people need a place to live, and that's sort of the natural extension of moving east. Part of it was driven by people wanting to move out there. Mesa in particular has been an area where we've seen a lot of moving for families that want to just sort of get out there. It's a great downtown. You have parks and trails, and I think just sort of the more open nature, and that we saw that ahead of time. But you also have the rise of the Pacific Fleet out here in San Diego. So when you have the rise of the Pacific Fleet, every time they add a new aircraft carrier out here, that adds about 3,000 sailors and their families to the market too. So that's just tons of demand that's flooding into South County too. And that's just, part of that has expanded just this year. So we're starting to see that filter there too. I do, yeah. Oh, sure. Were there any other questions at all? Oops. Yes.
I'm wondering, do you speculate on the impact of the moratorium lapsing on what that's going to do for inventory? It sounds like demand is there. It's going to get speeded up.
Sure.
Do you think it's going to show an impact?
So a question about the impact of the eviction moratorium falling off and what that might do. I think we'll see a little bit of a softening in rent growth as a result of that. I think there's all this demand here. It'll start to fill, and I anticipate we're not a market that can sustain 15% rent growth on a year-over-year basis continually. I think we'll start to see that soften, and by soften, maybe going from double digits to single digits to 8% or 9%. We're back to where the rent cap is. Demand, I don't expect demand to soften. I would just expect to see there just to be a little bit, I don't expect it to be as high as it is right now. It's probably going to take some time to see what's going to happen to those units. I think we have a lot of landlords that are waiting to renovate apartments that can't evict tenants because of just because of that side of the eviction moratorium. Once that side gets released, and I think that's pulled off, that was the more stringent eviction moratorium by the county, we might start to see more renovation work and more sort of evictions per se, and you might start to see demand for, spread out across the county, but demand is always going to remain high right now. Demand has never been the problem. It's just the height of demand that we're experiencing right now. Is it sustainable for 1.5% stabilized vacancy rate? It's hard to say. It's probably not sustainable at quite that low of a level, right? I would, as a PM, you sort of want that 96% occupancy, maybe a little bit higher, maybe 95%, helps you bake in stronger rent growth, right? As your units are naturally turning over, you get stronger rent growth on those units than you can on renewals, right? Fewer availabilities, such a high occupancy rate makes it more difficult to do that. So again, it's sort of the what if, or the great, what's going to happen. I'd like to have a crystal ball and answer it perfectly for you, but it's a little bit difficult to just say exactly what's going to happen because they've been kicking that can down the road for a year now. And again, I think they're probably going to kick it down. I would not be surprised if they were to kick it down the road through the end of the year, just because we still see that vacancy rate is 6.9% right now. We still have, 115,000 fewer jobs or fewer employed right now than we did pre-pandemic. So there's a huge segment of the market that is unemployed that is still going to have difficulty paying rent. And I think that they'll pay attention to that when they decide whether they're going to kick it down the road a bit. Yes.
Do you see any large commercial areas turning into residential, like shopping centers around here, or various areas where they have all this access to park? It's been there for years.
So the question was about, do we see any sort of perhaps mixed use sort of development going on or repurposing? I think that is a terrific idea. I think you have the dislocation from the coronavirus and what that's done to the retail sector has opened up lots of just large dark spaces, 120,000 square feet. I can tell you right now, there's not retail tenants right now that are looking for 100,000 square feet. Everybody wants Amazon to be the one that's going to swoop in. They're going to lease all the industrial space. They're going to take up all these retail big dark anchors and they can put last mile spots in them. It's probably not realistic to expect that. I think that is, look at what they did up at Westfield UTC. They built 300 apartment units and nobody knew, nobody cared. I'm of the idea there is neighborhood opposition to everything. But if you're in a neighborhood, are you going to care if you have 250 residents going in and out of that sort of, that mall area, if you will, or 250 shoppers going in and out of there? You have the infrastructure. You already sort of have that commercial dense mix right there. It's not going to matter. And it's a great way to repurpose properties. I could see that happening down in Chula Vista for some of the Sears locations that closed. We had this Macy's that just closed out at Parkway Plaza, and I think that parcel just sold for a redevelopment project. I think that would be a great thing to do out there at El Cajon. These are great ways of repurposing. You look at the central area, like Rancho Penasquitos, Rancho Bernardo, these areas where you have mixed-use development, I think is the perfect way to approach this and sort of kill two birds with one stone. Improve housing and get rid of these big dark anchors that nobody wants anything to do with anymore. So thank you very much. I think that was about the rest that my voice could take. So I appreciate it. Thank you all.
Thank you. On behalf of the association and the education committee, thank you for attending. I know a lot of you were taking notes. Just as a reminder, everything was videoed, so you can go back, rewatch the video, get his stats. So I just wanted to make sure you all knew that, just because it's hard to take pictures and write notes. So thank you very much for attending. Please visit the rest of the booth and remember to turn in your passport for the final drawing. Thank you.
Well done.
All right, thank you.
Excellent presentation.
Thank you.
Thank you so much. You've